Hello learners, let's discuss some problems of capital gains, and we hope that with this discussion the concept of capital gain will be more clearer to you. Let's discuss problem number 1. A piece of land was bought by Mr. Sharma in May 2004 for rupees 95,000 and the same was sold in April 2017 for rupees 1,50,000, where he has paid a brokerage rupees 10,000. The question is, what will be the taxable capital gain in the hands of Mr. Sharma? So now the question C, a piece of land, and the date is also important, May 2004, which he sold for rupees 95,000, and this land which is purchased at rupees 95,000 in May 2004 and he sold in April 2017 for rupees 11,50,000. So he sold in 2017, which he was purchased in 2004. So he held the asset for more than 36 months or 3 years. So it qualifies for long term capital gain. So let's see how the tax is being charged. Full value of consideration is 11,50,000, but the expenditure incurred in connection with transport of capital asset is 10,000. So net sale consideration is 11,40,000. Now, as it is a long-term capital asset, so we will calculate the index cost of acquisition. How the index cost of acquisition is calculated? The cost of CII on the year of purchase 113, while in 2017 it is 272. So 272 divided by 113 into the cost of acquisition 95,000, it comes to 2,28,672 or rupees 673, and which is shown here. So this is the index cost of acquisition. So when we deduct the index cost of acquisition from net sale consideration, we get long-term capital gain as 9,11,327. So I'm repeating, full value of consideration less any expenditure incurred on the transfer of the asset. Here in this case 10,000 rupees was spent. So net sale consideration is 11,40,000. We have calculated the index cost of acquisition, which is 95,000 into 272 divided by 113, and it comes to 228,673. Index cost of improvement is not there, so it is nil. So long-term capital gains taxable is 9,11,327 rupees. So this is problem number 1 at your solution. Let's see another problem. M furnishes the following information about his incomes during the previous year 2018-19. Capital gain rupees 20,000 from a house which he occupied for 1 year before the date of sale on 30/6/2018. Secondly, on 31st January 2018, he sold equity shares of XYZ Limited for rupees 2,20,000 through a recognized stock exchange, which were purchased by him on 1/4/2002, and he sold it at 31/1/2018. Securities transaction paid rupees 125. Fair market value of the shares on 31/1/2018 was rupees 1,80,000. Thirdly, he sold an agricultural land for rupees 6,50,000 on 30th April 2018. The land was owned by him since 4th July 2001 and was purchased for rupees 6,000. The land is situated with a population of 8,500. This is important for us. The land is situated in a village with a population of less than 10,000, that is 8,500. Next, on 28/2/2019, he sold a flat for rupees 12 lakhs, which was purchased by him on 1/1/1977 for rupees 50,000. The fair market value of the flat was 4,20,000 on 1/4/2001. So he purchased in 1977, sold in 2018. held for more than 3 years, obviously. So M is a resident of India. Compute his taxable income from capital gains for the assessment year 2018-19. So we have one, two, three, four cases. Let's see. Capital gain on sale of house. The first house, which is occupied for 1 year. So it is a short-term capital asset. So straightway short-term capital gain is 2,20,000. Shares 2,20,000. Cost of acquisition is 1,80,000. Long-term capital gain is 40,000, but this gain is exempted under section 10 subsection 38. Sale of equity shares. Capital gain on sale of flat. Sale consideration is 12 lakhs. Indexed cost of acquisition is 11 lakh 76,000. We have calculated the index cost of acquisition of 11,76,000 in this way: 4,20,000 into 280 by 100, it becomes 11,76,000. So this way it is being calculated. So long term capital gain is 24,000. So if we calculate short, that is the short term capital gain, and this is the long-term capital gain. This is not taxable. So total income, taxable income from capital gain is 44,000. So out of the five assets, if we see the cost of acquisition in first case, we have seen that in this case that is 1,80,000. This 1,80,000 has come from this calculation which we have shown in the note 2, that cost of acquisition is, it will be higher of cost of shares. 60,000 was the cost of acquisition, and lower of fair market value on 31/1/2018 of 1,80,000 and sale price 2,20,000. Whichever is lower of this, lower is 1,80,000 and cost is 60,000, higher of these two, so it is 1,80,000 is the cost of acquisition. Secondly, rural agricultural land which is situated in the village is not a capital asset, and there will be no capital gain on transfer of such agricultural land. So these are the five cases which we have seen. Now let's see question number 3. Mr. P shared the following information. Number 1. Car acquired by him in March 2011 for rupees 1 lakh was sold on 5th December 2018 for rupees 45,000. The written down value of the block on 1/4/2018 was rupees 25,000. So here the important term which you have to see is written down value. That means car is the depreciable asset. Ornaments costing rupees 1,50,000, which was acquired in August 2015, was sold for rupees 2 lakh in October 2018, was purchased in 2015. Self-cultivated land in an urban area was sold for rupees 15 lakhs on 4/1/2019, and its cost in 2023 was rupees 2 lakh 60,000. He purchased a new piece of land for his own cultivation for rupees 3 lakh 50,000 in June 2019. So he purchased a new piece of land. This is also important for us. House at Mumbai, let out for residential purpose. It was inherited by him in 1964. Sale price is 22 lakh 70,000. Fair market value on 1/4/2001 is 6 lakhs. Cost of improvement made during 2009-10 rupees 1 lakh 50,000. Expenses of transfer rupees 25,000. This is one comprehensive example. Household furnitures costing rupees 40,000 in 2002 was sold in March 2019 for rupees 50,000. So from the above particulars, we have to compute his total capital gain, assuming that he has no other income other than the mentioned above. Now let's see one by one. Car, as you know, it is a depreciable asset. Even though it is held for more than 36 months, but it is always will be short-term capital gain. So 45,000 minus 25,000 is 20,000. Ornaments, 2 lakh, it is also short-term capital asset. Less cost 1 lakh 50,000. So 50,000 is the benefit. So 70,000 is the total short-term capital gain. Let's see long-term capital gain. Residential house 22 lakh 70,000. As it is held for more than 36 months, so it will qualify for index cost of acquisition. Cost of acquisition was 6 lakhs into 280, the current CII, divided by 100, the CII of 2001 2, that is 100. So 16 lakh 80,000 is the inflated cost of cost. Cost of improvement, same case, 280 divided by the year in which the improvement took place. That year CII 148. So 1,50,000 into 280 divided by 148 is 283,784. Transfer expenses is 25,000. So total is 1988,784. When you deduct it from the sale consideration, 281,216 is the long-term capital asset, long-term capital gain. Next comes, so we have got the total, and this is the long-term capital gain, 2,81,000. Sale consideration for self-cultivable land is also taxable, 15 lakhs. Index cost of acquisition, as it qualifies for long-term capital assets, 280 divided by 105, 693,334. So capital gain is 806,666. But here he can claim exemption under section 54B, as he has immediately purchased another land. So 3,50,000 is deductible. So the balance 456,666 is taxable. So total long-term capital gain is 737,882, and when we add up with this 70,000, see total capital gain is 807,882. So this is a comprehensive problem, gives you an idea. Household furniture is not a capital asset, hence its gain or loss is not taxable. And section 54B, where the assessee claims an income a deduction of 3,50,000, includes the amount invested in new agricultural land. So this idea gives you a fairly comprehensive view of the capital gains taxation. Next, see question number 4. R shares the following information for the previous year ending on March 31, 2018. So he has got 1, 2, 3, 4, 5 kinds of assets. Shares, date of sale is 10th April 2017 for rupees 4,50,000, which he acquired 1 lakh 7 for 1 lakh rupees for rupees 1,70,000 in 2003-4, and the fair market value on 1st April 2018 is 1,60,000. Agricultural land in rural area outside municipal tax specifically mentioned. So it was sold in 25th May 2017 for rupees 25 lakhs. Cost is 2,50,000. Year of purchase is 8384. Agricultural land in urban area. 10th June 2017 he sold for rupees 71 lakhs. Was purchased for 7 lakhs. And the year 2006-7 fair market value on 1 for 2018 is 3,60,000. Debentures. He sold on 10th April 2017 for rupees 5 lakhs, which was purchased for rupees 2,50,000 in 2003-4, and the fair market value was rupees 2 lakhs. Personal car, which is sold on 1st July 2017 for rupees 1 lakh at a cost of rupees 60,000 in the year 2007-8. So 1, 2, 3, 4, 5. Let's see the taxable calculations. But before that, there is an information that on July 31, 2018, due date for furnishing return of income are deposits rupees 30 lakhs under section 54B for claiming exemption in future for purchasing agricultural land. As you know that there is a capital gains deposit scheme, so he deposited rupees 30 lakhs. By withdrawing from the deposit account, he purchased agricultural land for rupees 27 lakhs till June 9, 2019, assuming that the income of R for other sources from other sources during the previous year 2017, 18, 19, 20 are rupees 95,000 and 1,80,000 respectively, where to find out the taxable income of R for the assessment year 2018-19 and 2020-21. Crux of the problem is that he deposited rupees 30 lakhs in the capital gains investment scheme, but ultimately he utilized 27 lakhs. And the issue is that if the full amount is not utilized, the balance amount is taxable. Let's see the solution, how is it being shown here. Now, 1, 2, 3, 4, 5, we can show it in this column ways. Shares sale consideration is 4,50,000. index cost of acquisition, it is held for more than 1 year, he qualifies for index cost of acquisition is 4,24,220. Capital gains is 27,780, and there is no exemption. So the balance 27,780 is taxable. Rural agricultural land is not taxable, it is free. It is not a capital asset at all. So sale consideration is not taxable. Urban agricultural land is of course taxable. From 71 lakhs, we deduct the index cost of acquisition of 15 lakhs 60,656. So capital gain is 55 lakhs 39,344. And now mind it, he has deposited 30 lakhs in the capital gains deposit scheme. So he can claim exemption under section 54B. So the balance amount is taxable for the assessment year 1920, 1819. Debentures. He sold it for 5 lakhs. Index cost of acquisition is 2 lakh 50,000. So it is 2 lakh 50,000 is the capital gain. So balance 2 lakh 50,000 is taxable. Personal card is personal effects. It is not taxable as it is not a capital asset. Now let's see the computation of total income. Total income from capital head is 28,17,124. Income from other sources is 95,000. Gross total income is 29,12,124. There is no deduction. So taxable income for the assessment year 1819 is 29,12,124. Now what happened? The amount 30 lakhs which was deposited and which was claimed as exemption in earlier years, ultimately he utilized 27 lakhs. So balance 3 lakhs is taxable in the later assessment year with any other income. So in the year assessment year 2021, this 3 lakh rupees will be taxable, and in that year the total net income for taxability is 4 lakh 80,000. So these are the four problems and solutions which we showed to you, and hope that this gives you a comprehensive idea of capital gains taxation. Thank you very much.